Imagine waking up one morning and realizing that for years you've been paying extra for your car insurance without even knowing the real reason behind it. Not because you're a bad driver, not because you've had accidents, but because of something totally unrelated to your driving, your credit score. Most Americans have no idea that in 2025, your credit score is silently controlling how much you pay for car insurance. And today, I'm going to expose everything: the unfair reality, the hidden scoring system, and how insurance companies use your credit against you. Let me ask you a simple question. If two drivers have the same car, same age, same clean driving record, same city, shouldn't they pay the same amount? Of course they should. But the insurance industry doesn't work like that. They don't see you as a driver first. They see you as a financial profile. Before checking your driving history, they check your credit score. That's right. Your ability to pay bills determines how much you pay to protect your car. Sounds unfair? It is. Imagine two drivers. Driver A with a 760 credit score. Driver B with a 620 credit score. Both have clean records, not even one speeding ticket. Yet driver B pays 40 to 65% more every single month. Think about that for a moment. You're paying maybe $130 a month. Your neighbor is paying $70. Both of you have the same car, same road, same everything. But because his credit score is higher, he pays half. That's not just shocking, that's straight up exploitation. Insurance companies hide this behind words like risk index or insurance score or rating factor. But behind all these fancy terms is one thing: your credit score. You might be thinking, is this even legal? Here's the shocking reality. In more than 40 states, car insurance companies are legally allowed to increase your price based on your credit score. Only 4 states protect you: California, Hawaii, Michigan, and Massachusetts. Everywhere else, you're exposed. But things got even worse in 2025. Most companies upgraded their systems and started using AI-powered models. These models don't just check your current credit score. They try to predict your future score, meaning your insurance rate can increase even if you did nothing wrong. Your score drops 20 or 30 points, boom, your premium increases at renewal. Missed a credit card payment? Boom, insurance goes up, even if you drive safely. They don't need an accident or a ticket anymore. Your financial life becomes the reason they charge you more. And here's something even crazier. Even if you try to switch insurance companies, they still check your credit score before giving you a quote. So in most states, running away is not easy. But now let me show you how you can fight back. First, start with your credit report. Most drivers don't know this, but in 1 in every 3 credit reports contain errors. Maybe a wrong balance, maybe an old account still showing open, maybe a duplicate debt. All of these mistakes drop your score. Fixing even one mistake can increase your credit score by 20 to 50 points in just 30 days. And guess what? Your insurance rate starts going down. Second, here's a secret trick. If your score is between 580 and 650, call your insurance company and request a manual underwriting review. This forces them to check your actual driving instead of relying only on credit score. Most agents don't tell you this because they want you to pay more. Drivers who use this trick save anywhere from $200 to $500 a year. Third, shop around smartly. Not every insurance company punishes low credit scores the same way. Some rely heavily on credit score. Others rely more on mileage, driving behavior, or telematics. Switching companies alone can save you $300 to $900 a year. And there's one more thing you need to know, but I'll explain that in part 2. because that's where things get even more shocking. Welcome back. Now let's go deeper into how your credit score affects your insurance, and most importantly, how you can beat this unfair system in 2025. Let's begin with something new happening this year: telematics. Programs like Snapshot, Drive Ease, Right Track, and Drive Safe and Save can actually override your credit score penalty. Meaning, even if your credit score is low, if you drive safely for 60 to 90 days, you can still earn a discount. This is huge because for the first time, your driving behavior can be more important than your credit score. But now let me break down credit score ranges so you understand how insurance companies judge you. A score above 750, they treat you like gold, low risk, best rates. 700 to 749, still good, but slightly higher premiums. 650 to 699, now you enter the moderate risk zone. 600 to 649, insurance companies start punishing you big time. Below 600, insurance companies treat you like a guaranteed future accident, even if you've never had one. Think about this. Your credit score is supposed to reflect your financial habits, not your driving habits. But the insurance industry uses it anyway because it makes them money. Let's be honest. People with low credit scores might not have low scores because they're irresponsible. Sometimes life hits hard. Medical emergencies, job loss, unexpected bills, family problems. Real life situations don't care about your credit. But insurance companies only see numbers. If the number is low, your premium goes high. And the worst part, they never openly tell you. You only find out when you call and ask why your premium increased. And they say vague things like, "Your insurance score changed. We updated our risk model. It's due to rating factors." All code words for, "We checked your credit score and increased your price." But don't worry, you can beat this. Let's talk about how to raise your credit score fast so your car insurance drops. First, pay down high credit card balances. This has the fastest impact. Your credit utilization ratio is one of the biggest factors affecting your score. Even lowering your card balance from 80% to 40% can increase your score by 30 to 60 points. Second, never miss a payment. One late payment can drop your credit score by 50 to even 100 points, which means your insurance can skyrocket at renewal. Third, don't open too many new accounts in a short time. Every new account temporarily lowers your score. Fourth, monitor your credit score 30 days before your insurance renewal. This is important because even a small improvement, like 20 to 30 points, can bring your insurance rate down. And here's the final secret that almost no driver knows. If your credit score improves significantly, you can call your insurance company and request a rescore. Many companies check your credit score only once a year, but if you request it manually, they must check your score again. This alone can drop your insurance instantly. So here's the final truth. Your credit score is silently controlling your car insurance cost in 2025. The system is hidden, unfair, and designed to take more money from drivers who don't understand how it works. But now you know. You know the tricks, the hidden scoring system, and the methods to beat it. You're now ahead of millions of drivers who still think their driving record is the only thing that matters. Before you go, answer this in the comments. Do you think insurance companies should be allowed to judge your driving costs based on your credit score? If you learned something new today, hit the like button, subscribe, and share this video because the more people understand this, the harder it becomes for the insurance companies to hide the truth.